Hello, my name is Dr. Fred Sutton, and in this video I'll be presenting the balance sheet and providing you a little background about the balance sheets. And first what I will do is talk a little bit about how it affects you personally so that you can get a good idea of how it is, and then we'll talk a little bit about business statements and how companies use this as a part of that too. Alright, so if you watched my previous video discussed about the accounting equation, you'll have seen this equation before. And so assets are tangible and intangible things that you may have. Now let's take this on a personal sense first so that you can get a good idea of what that means. So the assets are something that you may have at your household. So like furniture, or maybe it is your house, or your car, or computers. Those type of things fall in the assets. So we have car, furniture, a house. You also may have cash. And those are some of the things that you may have as a part of it, as in your assets. Obviously, there are a lot more assets that you may have. You may have investments and those type of things. And so those are tangible and intangible. Tangible means something I can hold. Intangible means something that I can't hold, but it's a right to something that I may have. And those typical intangible assets when we talk about businesses are like patents and copyrights and those type of things that they may have that are very, very important to the business, but we can't really physically hold as a part of that. Now, liabilities are commitments to pay. And sometimes they're tied to an asset and sometimes they're not tied to an asset. So on these, I'm going to kind of go over some that are tied to an asset. So I may have a car payment personally, that's what I may have. Or I may have a house payment. When I'm talking payments, I'm looking at total what I owe on those. Then I may also have something called a credit card too, which is not tied to a specific asset, but it's still a commitment to pay. That's a liability that I may have. Now when I look over here as owner's equities, this is the right to the asset after we paid, after liabilities have been paid. So let me give you a description of what this means. These are my rights to that. So if I have a car for $25,000 and then I owe on a car payment for $10,000, I still have left on that, then I have a right to that. My equity in that vehicle is then $15,000. So as you can see here, I have that asset here, $25,000. I have a car payment of $10,000, then I have owner's equity of $15,000. That kind of gives you a brief overview of what it looks like personally to the balance sheet. But now I'm going to go into what it looks like for a business. So the business may have different things as a part of this. Yes, very similar assets, still be the same thing, but we may have a building as a part of that. I may have cash. I may have accounts receivable. And accounts receivable basically are, I'll just call them rec. But accounts receivable are is we did something for a customer, so maybe we're a landscaping company, and now they owe us that money. They have that commitment to pay us. So they have that's the debt that they owe us for that job that we did for $50,000. So maybe they owe us $50,000 for that. So that's part of those things. We also might have supplies. We might have inventory. We also may have prepaid expenses, which are expenses that we have prepaid. Kind of like your insurance on your car. Sometimes many people will pay those 6 months in advance, and so we have prepaid insurance because what we can do is then take that away and not have that. So we can have it at one company, decide to pull that from another company and go purchase at another company. So we have not used up that expense. Now liabilities may be a little different here, but similar to what you saw in the personal. We may have a mortgage note, similar to what you saw before. We may also have bonds payable, where a company may issue bonds to people or organizations and companies, and they have a commitment to pay interest over a certain amount of time frame, and they may pay that annually, quarterly, or semi-annually, and they'll pay the principal at the end. And then you may have notes payable, which is a commitment to pay, and usually requires interest, and it could be from 3 months to a year or several years. And then you may have accounts payable. So accounts payable is a commitment to pay. It's on a short-term basis, within a year. So typically an accounts payable is if I go down to another company and I need to purchase some basic material to develop our product, then what we will do is then in accounts payable is we may pay them within 30 days. And that is a commitment to pay. And so that's what we have here as an accounts payable. And again, owner's equity is we may have stockholders equity here, but it's basically the rights the stockholders have, or whoever that we have it here, to these assets after we have met our obligations here in our liabilities. So basically they have the equity that's left as a part of that company. So this is a brief description of the balance sheet and what it looks like and some of the accounts that are in each of these. I hope this has helped you today. My name is Dr. Fred Sutton, and that is the balance sheet.